First up this hour, Singapore's central bank has kept monetary policy settings unchanged for the first time this year, adopting a wait-and-see approach as policymakers gauge risks on economic growth as U.S. tariffs loom. While the Monetary Authority of Singapore said the monetary policy settings are for now consistent with medium-term price stability, MAS joins other global central banks in keeping their policy settings steady amid uncertainties over Trump's reciprocal tariff policy. Well, the central bank has already eased its policy stance twice this year to slow the rate of appreciation of the Singapore dollar. Let's bring in this morning Louise Loo, Head of Asia Economics with Oxford Economics. Very good morning to you, Louise. So what do you make of today's decision as markets widely expect the central bank to halt after it implemented 2 consecutive easings in the first half of this year?
Yeah, I think generally what we are seeing across the region, and MAS today confirmed it, is that central banks are taking a little bit of a breather. They are waiting to see how trade uncertainty will pan out. We've had a few deadlines in the horizon with regards to trade negotiations with the US. So nobody really has a very clear conviction over how what's going to happen on the trade front, but also what are the spillovers onto the domestic economy. I think the MAS statement is quite clear in that they are expecting that growth would slow in the second half of this year. So I think there's a little bit of preserving ammunition for further easing down the road.
Well, you've mentioned now recent data points show that some resilience in the economy, but underlying vulnerabilities still persist. So how will the policy decision impact the overall economy and prices amid the global trade uncertainties?
Well, I think it's worth bearing in mind that the fallout from what's happening on global trade on the uncertainty front is going to take time to feed through the economy, and the policy response is also going to feed through with a bit of a lag. So what we are really seeing in Q3, according to what our estimates at least, is that we are reaching a little bit of a trough in terms of the pullback in investments, and maybe some of the payback effects when it comes to strong exports in the first half of this year. So with that trough, we think that policymakers might respond more proactively in the second half of this year. Obviously not today, but perhaps in October. And then that's going to feed through to things that's going to keep inflation relatively resilient. We know that Singapore's output gap, as MAS also confirmed today, is likely to be broadly neutral this year. That means that inflationary expectations, inflationary concerns are likely to be contained. We are also expecting that certain segments of the economy would remain quite secular to tariffs. So they would do show some resilience despite the onslaught of higher tariffs. So things like services, things like construction, that's going to provide some tailwinds to an otherwise quite slow outlook.
And looking elsewhere, Singapore policymakers have warned of significant uncertainty and downside risks to the global economy in the second half of 2025. So could there be further policy easing in the next policy review?
Absolutely. I think the risk, our working assumption is that we have a wait and see in the July meeting, and in the October review, we have a more decisive easing stance. And that coincides with the fact that the economy will show more obvious signs of weakness going in a months forward. That also would take into account the fact that in other economies, in the global economy, especially key partners like China, like the US, they would start to also show a very significant deceleration in the coming months. So we would think that policymakers are not really being preemptive in this instance. They are being more reactive to the obvious weakness in the data.
You've talked a little bit about Singapore's inflation. We've seen it has moderated and the dollar has eased against the US dollar. So are there any lingering concerns on the strength of the Singapore dollar that could hamper exports and growth?
Well, I think at this stage, we think that the effects of currency strength on exports is going to be quite marginal. And the reason for that is that we're expecting that the US dollar, will hold up broadly stable in current levels. Of course, throughout this year, we've had a little bit of weakness in the dollar that was somewhat unexpected. But that strength is that weakness is likely to fade as people become more accustomed to tariff policies, as as the concerns of US exceptionalism fade away slightly. So I think that the Singapore dollar, in this instance, Singapore dollar is gonna stay somewhat on the strong side for a little while. But I don't think that's going to materially weigh on exports to the extent that regional currencies in general is going to ride the wave of a weaker dollar.
In the meantime, there are also concerns that the resilience of Singapore's GDP and also its exports are due to front-loading activities. Will we see some unwinding of those front-loading activities, and how will that impact GDP in the last 2 quarters of this year?
Yeah, so that's really the downside risk, the key downside risk that we're watching, which is that a lot of H1 strength is borrowed activity from H2. People front load activity to avoid higher tariffs. People front load activity to, essentially anticipate a slowdown and slower production in the following quarters. So we would expect some of that to unwind. We think that, if we estimate the amount of front loading activity that's happened and the amount of unwinding that needs, we think that there'll be 2 quarters of unwinding at least. So we should see at least half a year of export relative weakness in the coming months. Now, having said that, I think another thing that to also take note of is also not just front loading activity, but also inventory stockings. So industries not just shipping out their statement, they're shipping out their goods, but also basically filling up their shelves with items that haven't really been sold. We see a little bit of an inventory build in some economies where data has already been available in recent months. In Singapore, we don't have that data yet, but we're expecting that there should be some inventory building as well. And if that should unwind in the coming quarters, that would also be a drag to growth.
Well, Louise, one last question before we go. So, we're also expecting the Federal Reserve policy decision tomorrow or later this evening. So do you think a change in the Fed stance will affect central bank decisions here in Singapore?
Well, I think it would affect currencies. That's the most direct transmission. But given that our expectation is that the Fed would likely stay on hold, I think in general the rate differentials with much of Asia, including Singapore, is going to stay fairly stable. And I think that the fallout for that is going to be quite manageable as well.
All right. Thank you so much indeed, Louise, for your analysis. Louise Loo, Head of Asia Economics at Oxford Economics.